Welcome back, guys. In this video I'm going to teach you the basic ideas of how your credit score works. You've got two different types of credit scores. You've got the FICO score and you got the Vantage score. The FICO score is really what matters in the real world, as in when someone pulls your credit, they're going to be looking at your FICO score. But your Vantage score is something similar, and you can also see it on websites such as creditkarma.com. Now, the first thing you want to do if you haven't already done this, go to freecreditreport.com and pull your credit. You've got 3 different credit bureaus: TransUnion, Equifax, and Experian. Anytime someone lends you credit, they are reporting how you are doing with this to each one of these credit bureaus. And they keep a record of all that for the past 7 to 10 years. You can get your own copy of that report on freecreditreport.com. So let's talk about what goes into your FICO score. The basic idea is someone wants to know your credit worthiness, okay? Should we loan this guy some money or not? Okay, you always got to keep that in the back of your head. That's what it boils down to. Pay your bills on time and reduce your debt. So your payment history makes up 35% of your FICO score. Payment history is all about whether or not you paid your bills on time. Did you have any missed payments? If you have an agreement with someone to pay your bills X amount of dollars every month and you miss one of those payments, that looks really bad. So that can really hurt you. So if you want to improve your score, the first thing you got to do is just simply pay your bills, right? So when it comes to bills, you've got 2 different types. You've got installment loans and revolving loans. Installment loans are like a car bill. A mortgage is where you owe X amount of money and every month you're paying it off to slowly chip away at that debt, right? That's installment loans. Revolving loans is like a credit card, where every month what you owe can go up or down. Like you could owe $200 this month, you could owe $20 the next month, you could owe $500 the next month. It just goes up and down, depends what you put on the card. That's called revolving loans. Let's talk about the next thing. Credit utilization makes up 30% of your credit score. Credit utilization only applies to revolving loans, not installment loans. When it comes to installment loans, it's simply about whether or not you're paying your bill on time. When it comes to revolving loans, it's also about whether or not you're paying your bill, but it's also about how much of that block of credit are you utilizing. If you have $1,000 of available credit and you're utilizing $500 of that, that's how much you put on the card, then you've got a utilization rate of 50%, right? So what's the optimal utilization rate? Well, you've got different categories, okay? This is how it breaks it down. Between 1 to 9% is the best. That's just considered the best. The next is 0%, okay? Which means that you're putting nothing on your bill, okay? That still looks good, but it's not quite as good as 1 to 9%. Then you've got 10 to 30%, okay? That you're kind of getting a little murky waters. It's not too bad, but it's like, okay. And above 30%, don't even think about it, okay? You really do not want to put more than 30% of your credit on your credit card. Now, how does this work? At what point in time is your credit utilization defined? It's defined on your statement date. Your statement date. You look at your credit card, you've got a statement date. So let's say it's April 21st. So between March 21st and April 21st, it looks at everything that you've spent, and it looks at your ending balance, okay, on your statement date. So if your ending balance on your statement date is $200, then you've got a credit utilization rate of 20%. Now, you could have put $800 on the card, 3 days later you paid it off. You could have put another $1,000 on the card, 3 days later you paid it off. But if on your statement date, that's what matters. On your statement date, if you only have, say, $50 on there, then your credit utilization is 5%, right? There's another date that's important, which is your balance due date, okay? So your statement date, let's say it's April 21st, maybe you gotta pay that on April 30th, okay? Your balance due date, that's all about when you have to pay, but that doesn't have anything to do with your credit utilization, okay? So don't get those two confused. They sound similar, but they're a little bit different. The age of your accounts make up 15% of your FICO score. What does that mean? I mean, it just means if you had like a car loan that you've been paying off for a while, you've been making good payments, faithfully paying it down, you've got a credit card that you've had open for a long time. That shows that you've got a long history of being of making your payments on time. And that looks really good. That makes up 15% of your score. Okay, and that's something that you really can't change overnight. I mean, just by the very definition of it, it takes time in order to do that. So, and that's also kind of goes into why you kind of want to avoid closing your credit cards. I mean, sure, go ahead, close it if your credit card is charging you like an annual fee and you don't want to pay that anymore. But besides that, you want to kind of keep them open even if you're not really using them, because it helps extend your average credit history, the average length of your credit. The diversity of credit makes up 10% of your FICO score. What is the diversity of credit? It means, like, if you have, say, a car loan, a boat loan, a mortgage loan, if you have some credit cards, you've got student loan debt, you've got whatever. You think of all the ways you can own debt. You know, you've got the diversity of different ways. The more diverse different types of debt you owe, that's the better your score. And it makes up about 10% of your FICO score. Now, just to be warned, you should not go out and go into debt just to get your score up. No. That's not what you want to do. If you want to get your score up, get a credit card and simply put things on the credit card and pay it down every month. Okay? Don't carry a balance. When it comes to the due date, pay every single bit of that credit card. But it helps if on the statement date you have between 1 and 9% on that credit card. And by the way, when it comes to credit utilization, this is about all your credit cards. Okay? It's about, you add up the credit limits of all of them, you add up how much you owe on your statement dates on all of them, and that's your credit utilization. So it's okay to have a little bit on there for your statement date, but when it comes to your balance due date, do not leave anything on there. Pay every single bit of it off. Why? Because obviously then you're going to owe interest, right? Do not pay interest on credit cards. Do not carry a balance. Hard inquiries make up 10% of your credit score. What does that mean? Well, it means, let's say you're applying for some type of loan, a bank is going to look at your credit report. That's a hard inquiry, okay? Now, there's two different types actually. So there's a soft inquiry and a hard inquiry. Okay, sometimes they may do a soft inquiry and then do a hard one. Basically, the whole point is that a hard inquiry means that it's going to hurt your credit score a bit if you have too many of those within the past 2 years. Because it's like, okay, this guy is going out getting debt left and right. Well, like, why is he constantly trying to get credit? You know, that doesn't look too well. It's okay to have a little bit, but not constantly. Either way, this isn't going to affect you too terribly. It makes up 10% of your FICO score. Okay, here's another little trick. You've got a grace period of about 45 days, where within a 45-day window, let's say on day 1, you get a hard inquiry. You can have as many hard inquiries you want within that 45-day period, and it will count as one hard inquiry. Why? Because if you're going out to get a car loan, you may want to go to multiple different dealerships, see what's the best deal you can get. Same for buying a house. It'd be nice if you could do that, be a smart shopper, and not have to worry about it completely screwing up your credit. So that's why you have that grace period. But that only applies to something like basically installment loans. Like if you're looking for a car, you're looking for a house. It does not apply to credit cards. Okay, so you know, each time you get a hard inquiry from a credit card, yeah, that can potentially hurt your score a little bit. So those are the factors that make up your FICO score. If your score is already pretty good, what you want to do is probably just keep doing what you're doing, and over time, the average age of your credit accounts will get older and older, and that's going to increase your score. Make sure you're in the right category for credit utilization. Okay, you want to be between that 1 and 9%. There's something else I forgot to say about credit utilization. Credit utilization does not have a memory, okay? And what that means is that your score is just based on your credit utilization for the past month. How you did the month before that, the year before that, that doesn't matter. So if you're the type who wants to increase your credit score really quickly, let's say you're in the 600s, 500s, and you want to increase it like quite a number of points, if you get your credit utilization in check, it'll almost instantaneously jump up, because your credit utilization is just based on that one snapshot right there. If your credit is really bad, You want to focus on making your payments on time. And I'm going to have another video specifically targeting how to improve your credit if you have really bad credit. I'm also going to make another video addressing whether or not you need to even worry about this. I mean, does it even matter about your credit worthiness? Do you need to have credit cards open? Do you need to have car loans open? I'm going to address all that in another video, so stay tuned. If you like this video and you want to support the channel, like, comment, and subscribe. Share this video with your friends. We're trying to grow the channel. We got a few subscribers now. We're going to get to the 100 subscriber mark, and then we're going to go on up. We're going to take this places, all right? So support the channel, like, comment, subscribe. Peace.